Hello, everyone. Welcome to Credit Repair and what it means for you and your clients. So today we're going to talk about credit, how it impacts your clients, but also what it means on a general scale. So why does credit matter? Well, credit is very important when it comes to buying a house with regards to what programs you qualify for, whether you qualify for down payment assistance, but it also matters when it comes to interest rates and what is going to be provided or what is available to you. Outside of buying a home, it's also important. Let's say you're buying a car, or if you're buying a home and putting utilities in your name, whether or not you have to put security deposits down based on your credit and also your ability to pay bills. Factors that do influence your credit score are such things as payment history, amount you owe, length of your credit history, new credit, and credit mix. So payment history is just that. It looks at 6 months, a year, or even the life of your credit and whether or not you've paid your bills on time. When we pull credit, we'll look at the last 12 months, 24 months. All of this will affect your credit score as well as an approval when it comes to buying a home. So amount you owe, very important when it comes to revolving credit, which is a credit card, keeping balances in check, whether it be under a 50% utilization or a 35% utilization. Keep in mind, your credit is determined by a computer, which looks at percentages of your credit used. It also is important to have credit for a long period of time. So whether or not you've just opened a credit card or you have had a credit card open for 20 years, there is a big difference. All reports and everybody will tell you that it is more important to have credit open and keep it open the same line for a long period of time. For instance, opening a credit card and closing it will actually negatively impact your credit. It gets rid of your credit history as if it doesn't exist. Opening a credit card and stopping not using your credit anymore also impacts your score as if it were not there. You want to be able to establish credit and keep it open. The longer you do, the better your credit score. New credit, something establishing when you're younger, it takes almost a year for it to establish and create a credit score or a viable credit score. There's also some loans which require 2 or 3 trade lines open and available over a 12-month period for them to allow you to do a loan. Credit mix means types of credit you have in your name, whether it be a credit card, an installment loan, a student loan, a car loan. All those are different types of trade lines, impact your score differently. So some of the common credit issues, a lot of these are common sense, but keep in mind when you're dealing with some of your clients, they may not have any idea what impacts their credit score. Missed payments, high balances, inaccurate information, and identity theft all are very important when it comes to what the credit score is going to be. So missed payments, just what they are. Let's say your credit card is due on the 1st and you don't pay to the 20th. Next month, that will be reported as a late payment, which will negatively impact your score. This on top of having high balances, which we see a lot of nowadays. If you have maxed out a credit card and then you are late on it, it shows your inability to pay or keep up with your bills. Inaccurate information or identity theft, 2 very important things. Inaccurate information is essentially someone else's information reporting to your report. Happens a lot when people are junior or senior, or even if someone types in an inaccurate Social Security number and it gets reported to your credit report. Identity theft, a little bit different, where someone steals your information, opens accounts in your name, and goes and spends and never pays any of the bills. So 2 very important things to watch out for because they both negatively impact your score. So improvement tips. We've talked about what impacts your score. Now let's talk about what actually improves it. Keeping balances low, paying bills on time, and diversifying your credit. So keeping balances low, as we talked about before, keep in mind this is a computer that scores it. 50% is one tier, 35% is another tier. As you keep your balances under that, that is your utilization. So $1,000 at 50% is $500 you've used. 30% is $300 you've used. Those are important or key levels when a computer is looking at and scoring it. Paying your bills on time, not having lates, all important things to look at. And then diversifying credit, meaning revolving accounts, installment loans, all of them factor in when it looks at credit and whether or not you can pay your bills on time and manage your budget. Some of the red flags that we as lenders look at when we're underwriting a loan, and I'm sure other banks do when they're looking at for buying a car or anything like that. But applying for too much credit, someone who goes out and opens 3 or 4 credit cards all at once. You'll see this a lot with buying a car. Sometimes it shotguns it out, where they'll send it out to multiple banks who all open your credit. Not that you're applying for multiple lines or buying 10 cars, but it looks as if 10 people are pulling your credit to buy something different. Closing your credit accounts. We talked about this. After, if you have a credit card open for 5 years and have paid on it and done well, credit limits up there, and you close it, it is essentially like getting rid of your credit and starting over. It is important also not to max out credit cards. Even if you are paying on time, that impacts your score negatively. One of the important tools that we use, and this may help if you're in the real estate industry and dealing with clients, is hard credit pulls versus soft credit pulls. A hard credit pull is essentially a bank pulling it as if you are buying something today or tomorrow, applying for a loan, car, house, what have you. Soft credit pull, very similar to an institution doing a non-credit related, meaning a background check or something like that. Big differences are when we do a hard credit pull, credit bureaus actually sell that information. You get 50 million phone calls or emails from creditors wanting to sell you something or get your business. Soft credit pull, that information is not sold and it does not impact your credit score. This is a great way if you have buyers who are on the fence and are looking at homes, but are not interested in getting their credit pulled. They still want to look at houses, but don't want to go or talk to a lender. This is a way to know what you're dealing with. We can do a soft pull, look at their credit, even run simulators and work on qualifying them before we do the hard credit. This shows you as a realtor that you are working with a viable client and it is okay to keep showing them houses versus someone who needs to do, let's say, 6 months or even a year worth of credit repair before they can buy. All of this information can be used with your clients and is information you can pass along as you're having conversations. If there's any other questions or anything that comes up, let me know. I'm happy to go over all of this with you. Stay tuned. We'll have more great updates and more information later on. Thanks.